join could. So good evening, good afternoon, or good morning, depending on where you are on the globe. Welcome to today's webinar. It's a new addition to the E-Access Forum on Climate Change, Macroeconomics and Finance. And maybe before starting, I would like to invite you to join the E-Access Forum on Slack. So the Slack page that we provide is a workspace in which researchers, regulators and central bankers can exchange on issues of monetary policy, financial regulation, climate change and the environment in general. And on this page, you will find a curated and comprehensive stream of working papers, news, and conference information. So you can join the Slack page via the link that is posted in the chat. So today we will address a burning question in the current debate. Do financial markets fully reflect climate risk in their prices, or do they fail in some way to reflect them? And as you can guess, the answer to this question is crucial. If markets do reflect climate risk, if they underestimate them, for example, in the case for central banks and supervisor in general to correct what could be a market failure. As you might know, this question is very much debated now in academic and policy circles. And I think that financial supervisors are currently rather inclined to consider that financial markets do not fully reflect climate risk. And then this is, for example, the position of the ESRB and the ECB in their recent publication and speeches. So to help us make our mind on this issue, I'm delighted to welcome today Renato Faccini, who will present his latest empirical study on precisely this question. And he is joined by his two co-authors. Renato is Deputy Head of Research at the Danmarks Nationalbank. And prior to joining the Danish Central Bank, he worked at the Bank of England and at Queen Mary, University of London, as an associate professor. Renato was also a visiting scholar at University College London and a George Fellow at the Bank of England. Many thanks, Renato, for joining us, and also to your co-authors, Rustin Martin and George Skiadopoulos, who are also present today and can, of course, intervene whenever they want to and to add some precision to your talk. Before giving you the floor, let me start with two questions for the audience related to today's topic. I will let everybody fill this question. The first one is, are climate risk reflected in financial market prices? And the second one, what methodology do you think is best to assess whether climate risk are priced? So the answer to this question will inform the debate today. Let's wait a couple of more seconds to have everybody answering them, and when it's ready, Adrian, you can show us the answers. So maybe now everybody has voted. Okay, so very interesting results. 3/4 of the people present today think that climate risk are partly and inefficiently reflected by market prices. And about the methodology to use them to assess them, I cannot see the end of the question, but apparently it's panel regression, which seems to be the preferred methodology. So with this in mind, Renato, the floor is yours. Thank you for your future presentation. And before we start, please post your question in the Q&A section of this webinar. And there is also the opportunity to ask the question directly after the presentation by raising your hand. Renato, please.
Well, thanks a lot for the nice introduction, Pierre, and for the poll to get the audience started on this. And thanks for inviting me to present this paper to your excellent series of webinars. It's really very nice opportunity for us. Let me try and share the screen. Can you see it?
Yes, perfectly.
Yes, okay. So this is joint work with Rustin Matin, a colleague from the Danish Central Bank, and with George Skiadopoulos from the University of Piraeus and Queen Mary in London. The work that is presented here does not necessarily reflect the views of the Danish Central Bank, of the European system of central banks. So, okay. So as you know, there are different types of risks that stem from climate change. Some of these risks are physical in the sense that the realization of these risks entails a direct impairment of the productive assets of companies, for instance, as a result of the damage derived from hurricanes, floods, wildfires, and other natural disasters that are also a consequence of climate change. Other risks are transition risks in the sense that they stem from the transition to a low carbon economy. And this can materialize, for instance, if government decide to implement a carbon tax or the like, or also if preferences change and shift in a way that reward green companies relative to brown companies. So the question that we ask here is whether stock market prices reflect these different types of risks. And the answer to this question is not obvious in advance. We know from survey studies that some institutional investors believe that climate change risks are not as important as other risks. And even when they do think they are important, sometimes they think they are hard to price and hard to hedge. We also know that some institutional investors who want to decarbonize their portfolio, they actually face big transaction cost in doing so. But on the other hand, we also know that if, say, a carbon tax is introduced, this is going to have a direct impact on the cash flows of businesses, and therefore this should be reflected in stock prices. Now, why is it important to ask these questions? Pierre, you addressed this already, but so whenever there is a big source of risk, a substantial source of risk that is not priced, this is a threat for financial stability. And we know that arguably we could say that if in the early 2000s the risks stemming from asset-backed securities, of mortgage-backed securities, were properly priced, we may have spared perhaps the Great Recession altogether. Now, lots of work has been done on these sources of risks. Regulation has changed to incorporate the findings of the academic literature. We think it's time to devote our focus and our attention on this new potential threat to financial stability that derives from climate risks. So the contribution that we present in this paper is twofold. The first contribution is that we dissect climate risks using textual analysis, and this leads us to propose novel measures for market-wide physical and transition climate risks. And then we use these measures of risks to check whether these are priced or they are reflected in US stock prices. So in this field of textual analysis, we provide first-time evidence in the test for this heterogeneity of climate risks. So in doing so, in carrying out this asset pricing test, we provide and validate a possible explanation for the results. So let me give you a quick preview for our findings. So we're going to identify 4 factors that have a clear interpretations. two of these factors, the factor that capture risks of natural disasters or stemming from global warming, reflect longer running physical risks, whereas the textual factors that elicit the risks stemming from international summits and from the US debate on climate policy, they capture transition risks at a longer and at a shorter horizon, respectively. Our finding is that only one, the latter, of these risks is priced, the risks that stem from the US debate on climate change. And we find that this evidence of pricing is also a recent phenomenon that stems only from post-2012. Which is in line with the idea that attention to climate change is a recent phenomenon. We document a risk premium for this risk, which is consistent with the idea that investors try to hedge against this type of risks. So in the interest of time, I will skip the outlined and related literature and go to the heart of what we do in our paper. So the data that we use for our empirical analysis is going to be news articles from Reuters that have been published from the 1st of January 2000 to the 31st December of 2018. We've got more than 13 million articles available from Refinitiv News Archive, but we're only interested in those that address the issue of climate change. So we are going to filter out only those articles that features the words climate change or global warming. And that is going to leave us with a working sample of 34,000 articles. Then we also have daily returns from the universe of the stock listed in the US market, which means that we observe on average daily return for 4,700 firms in this period and a total of over 10,000 stocks. We download equity risk factors from the authors' websites, and we are going to make use of the environmental pillar of the ESG scores produced by Refinitiv. So first, our textual analysis. Remember, the objective is to dig into the heterogeneity of the textual corpus. So we want to dissect different types of climate risks. And in order to do so, we make use of a methodology that is standard in textual analysis. It's called the latent Dirichlet allocation. And so what this methodology does is to produce two outputs. The first output is that this is going to decompose the entire textual corpus into K topics, where a topic is a probability distribution over words. So intuitively, in a given topic, some words will occur more frequently than others. And the words that occur most frequently are going to be informative about what the topic is about. Now, the second output of this textual methodology is that it expresses every single article of our set of 34,000 articles as a probability weighted average of these K topics. So to give you an example, one article can be 60% about natural disasters, but also 20% about international summits, and then we'll have other weights over the other topics. These weights are called topic shares. So they reflect the percentage of a given article that is associated with a given topic. It reflects the intensity by which a topic appears in an article. What we are interested in is in finding a time series of coverage of a given topic. So how do we do that? Well, in every day, so at every time t, we simply sum the topic share of a particular topic across all the articles that are published in that day. That is going to give us a measure of the intensity of news coverage of that topic in that day. If we do that for all the days in our sample, we are going to get a time series. Now, to help you visualize what we are talking about, this is a topic the words that appear as bigger means that these are words that are more frequent in that topic. So as you can see, this topic here is about the realization of extreme weather conditions, natural disasters that hit different countries through storms and natural disasters like floods, fires. So this is going to be a natural disaster topic. The user, we label this topic as natural disaster. This is another topic. This is a topic where, again, the big words are those that appear more frequently. So what is this topic about? This is a topic about the global warming, so the behavior of average temperature, which has been rising through the centuries. And in this topic, a clear association is made between rising temperature and the consumption of fossil fuel. So we label this topic as a global warming topic. Now, this is a topic that reflects about information about international summits, which in our sample, especially the first part of the sample, have been mainly about ratifying the protocol that was agreed in Tokyo, in Kyoto, in Japan, where rich states agreed to cut on the production of greenhouse emissions. And subsequently, a lot of the discussion has been how to go on after Kyoto. And the Copenhagen agreements here show up in this topic. So this is clearly something that is about international summits. And finally, we have two other topics that reflect on the debate, the political debate on climate change in the US. This is a topic that is about the debate of the legislation about energy standards in the US at the state level, which is why, for instance, California appears there, because it's a state that has been very active in this, in this legislation. And there is another topic here, which instead is about US politics at the federal level. As you can see, what is discussed here is political views that are expressed during the political campaigns, but also in the debate in the House of Representatives, in the Senate, about the passing of bills that are related to climate change. Now, the union of these two topics, the federal and the state level, is what we will use as a working topic for our, what we call the climate policy or US climate policy factor. So these are the topics. Let me show you how, yeah, I can jump this in the interest of time. This is just, let me concentrate on the time series of this topic, how the news coverage of these topics evolves over time. So this is a time series for the news coverage of the topic of natural disasters, which, as you can see, this time series tends to spike in relation with very important and severe natural disasters that include hurricanes, but also floods and wildfires. So clearly, an increase in news here, in news coverage, is a bad signal to the economy. It signals that as the health of the planet worsens, similar natural events may become more frequent. Something that is worth noting here is that the disasters here are global. This is not a time series of disasters in the US. Most of these disasters take place outside of the US. So a spike here is not something that is going to carry out a direct impact on the US economy, but rather it's a signal in the news that these disasters are catching the media's attention. So they are a signal, perhaps a warning signal, that similar disasters may become more frequent in the future and also be more disruptive in the future, also in the US. So this is how we interpret this factor. And therefore, we believe that this can carry information about longer running physical risks. This is a time series for the global warming factor. The articles that report on this global warming factor are typically reports by governative and non-governative institutions, but also very often this is just the publication of scientific papers about global warming and that connect the increase in temperature to man-made climate change and the increase in the consumption of fossil fuels. We have a similar interpretation of this time series as a risk factor, whereas news coverage here is signaling concerns that rise to the media's attention about the worsening of the health of the planet. So again, capturing these sorts of longer running physical risks. This is instead the time series of the international summits factor, which you can see that it spikes whenever there are important international gatherings. A lot of these gatherings are about preparing for a new gathering in order to try and over time reach some kind of agreement about the introduction of a world tax on carbon. So it takes a long time for agreements to be reached at the international level, and it takes time once agreements are reached for this news for this agreement to filter through the domestic legislative process. So we interpret this coverage here as capturing some longer running transition risks. Of course, what is at stake here is the introduction of some tax, and we interpret the introduction of a tax to be some sort of bad news for the economy in transition, where by bad news we mean that a tax is going to have a negative impact on aggregate GDP, which is the price to pay for climate mitigation. Here instead, this is the time series of news coverage of our climate policy factor. And you can see that the news here, they reflect the debate that takes place in the House of Representatives, in the Senate, about the passage of bills, but also views expressed in the political campaign, as well as the nomination of key figures with very clearly defined political views on climate that have been nominated for position of power for the environment. So here, whether an increase in news signals an increase or a decrease in transition risks eventually depends on where is the political balance of power, and this is something to which we will come back in this presentation. But what I would like to emphasize here is that we interpret this time series as capturing some shorter running transition risks, because whatever view is proposed about the passing of laws, whatever intention is expressed in the articles about this debate, any intention or even any action can be reversed in a matter of a couple of years, as there is a new election that changes the balance of powers in the House of Representatives or in the Senate, or whether it leads to a new president being elected. So these are our 4 time series, which we interpreted as capturing different sorts of risks. And so the second part then of the paper is to carry out asset pricing tests. And we start by carrying out some portfolio sort test. So what we do here, for every stock I, we are going to run this regression, where on the left-hand side, we have the excess return over the risk-free rate, which is regressed on a constant, on the factor, which is one of the time series at a time that you've seen before. And then we control for a standard set of factors that are known to be informative for the cross-section of stock returns in the US. So if a stock is estimated to have a negative beta, that means that that is going to be a stock in which the returns fall when news coverage increases. A stock with a positive beta will have instead returns that increase when news coverage increases. So stocks with negative and positive beta, they have opposite responses to the same news factor on average. So what we're going to do is to sort the stocks into decile and quintile portfolios based on their estimated betas. And what we do then is we calculate monthly post-ranking portfolio returns that are value weighted. And what we are interested is in the returns of the spread portfolio, which is constructed as the returns on the high beta stock minus the returns on the low beta stocks. We do a rolling windows estimation, so we repeat these estimations until we exhaust the sample. And ultimately, we want to estimate the alpha of the spread portfolio. If the alpha is significantly different from zero, then we can reject the null that the factor is not priced. So we interpret that as evidence of pricing. And in doing these exercises, we consider different models to estimate both the betas and the alphas. So this is the table that shows our results here. We report results for the four factors that I've shown you earlier on in each column: natural disasters, global warming, international summits, and US climate policy. In the rows, we look at different models: the market model, the three-factor Fama-French model, the Fama-French cohort, the 5 factors Fama-French model, and the 5 factors Fama-French model to which we add a momentum factor. Basically, these factors here, these different models, they entail different controls that we put into the X vector of this regression. Okay. So the bottom line here, what you are reporting, these are the alphas, and in brackets are the t-stats. So what we see here is that there is anything here, there's nothing significant for natural disasters, global warming, and international summits. The only factor that comes up significant is the one on US climate policy, which is always significant across models when using deciles. A similar picture arises when we sort stocks into quintiles, but we get less robustness in the case of US climate policy. So why do we bother with looking into the heterogeneity of climate change risks? We could have simply taken the counts of climate change in our sample, and we could have constructed a time series of attention to news attention to climate change. And if we used this time series as a risk factor, we'd have obtained that nothing comes significant. So that risk factor, we would have said climate risk is not priced. But reality may be more complicated than that, with the market paying different attention to different sources of climate risks. And that's what we uncover or try to uncover, dissecting the heterogeneity of climate change risks. Now, how do we interpret these positive alphas that we find in the portfolio sorts? The possible explanation that we propose is that investors want to hedge against the realization of the risks elicited by the debate on US policy. And in order to support this explanation, we make a conjecture. And the conjecture at this stage is that a decrease in the factor, so a decrease in news coverage, translate into an increase in transition risks. What this means is that what we are assuming or conjecturing at this stage is that an increase in news coverage about the US political debate tends to reassure investors that transition risks will not materialize. So more coverage is more reassurance. Less coverage is therefore less reassurance and more risk. So a fall in coverage is bad news for the economy because there is a higher risk of introducing a tax that will have negative adverse effect on aggregate production. It deteriorates the investor's opportunity set. So what would an investor do in order to hedge against these risks? Well, to hedge, an investor would like to buy the stocks with a negative beta because those are the stocks that pay positive returns when news coverage falls and risks increases. They would rather short sell the stocks with a positive climate beta. But by doing so, the price of the negative beta stocks would rise, their return would fall, and therefore we would get a positive return on the spread portfolio, as we find. But how do we check that this conjecture holds? So we're going to take two approaches. The first one is going to carry out some subsample analysis, first focusing on the period after 2012, which is the period of time I'm going to argue where this assumption is more likely to hold. And then we're going to use a narrative approach, a bit like in the spirit of Romer's and Romer narrative approach to construct monetary policy shocks. So we're going to read all the articles, understand the content of these, mark it, and then use that as a factor. So this is the subsample analysis using the raw factor. What happened after 2012? After 2012, we had 4 years of the Obama administration in which President Obama did not control the Congress. The House first, and then also the Senate turned Republican, and the president was not able to push his desired climate change legislation through the parliament. And then from 16 and onward, we had the election of Trump, whose declared intention on climate was to undo any progress that Obama was able to make, and he followed through on his promises. So this is the period where you would assume that our conjecture is more likely to hold. And then if you look at the results of our portfolio sorts in the pre-2012 and the post-2012, there you see that actually all the significance in this factor comes from the post-2012 period, which is when our assumption is more likely to hold. And the results are more robust also when you look at quintile portfolios, which were not very robust on the full sample. So then what we ask is what are the characteristics of the firms that are identified to be in these different quintiles of the portfolios in this period where we get stronger significance after 2012. So here we are plotting some characteristics of the stocks in different quintiles. And the fifth quintile is the quintile where we have the high beta stocks. So this is where we find the stocks of the firms that stand the most to lose from the realization of climate risks. So who are these firms? Now you would expect that if anything, these firms should be more polluters. And so we check this using looking at the environmental pillar of the ESG scores produced from Refinitiv. These are very imperfect measures. They have been criticized, like all other environmental scores, for being very noisy. But still, what is reassuring is that we do find that the E-score reaches its lowest value for this fifth quintile. What is perhaps puzzling instead is the fact that we do find very low environmental scores also in the first quintile, which is the quintile of the firms who are considered by investors, according to our interpretation, as a potential hedge against the realization of climate risk, of transition risks. So this is this is certainly puzzling, but perhaps a solution to this puzzle is in looking at the change in the environmental score. If you look at the change, then the first quintile is also the quintile where you see the higher positive change in the E-score. So it looks like these firms that are considered as a hedge, these firms that the market rewards in this sense, are firms that may be brown today, but are taking the most concrete steps into becoming greener and investing more in this direction. Now, this interpretation aligns well with some findings by Cohen and co-author, who document that in the US, some energy firms and most polluting businesses appear to be those who are producing the higher, the biggest number of patents, of green patents, and also the ones that are that have better quality and get most citations. What they argue is that the environmental scores are not good enough at fully capturing the extent into which these some of these firms are really innovating in terms of becoming greener. Now, despite the fact that environmental scores are mismeasured and noisy, it's still comforting that we do find something that supports this narrative. So then something else that we do do Fama-Macbeth regression. This is just another methodology that we carry out that ends up just confirming similar results. I would rather not spend perhaps much time on this given the time constraint, and dedicate more attention to the other approach that we take to validate our conjecture of this arbitrage story. So what we do here, we are going to select the articles that have a topic share on this US climate policy factor that is bigger than 40%. So we take all the articles that load very heavily on this topic, the topic on US climate change. And this is going to leave us with a sample of 3,500 articles. Then what we do is we read each of these articles. And for every article, we apply our judgment to tell whether the content of the article is signaling an increase in transition risks, in which case we mark it with a +1, whether it signals a decrease in transition risks, in which case we mark it with a -1, or if the content is mixed, then we mark it with a 0. So we really account for the content of the news by doing individual reading of all the articles. And what we want to produce is a time series for this factor. So how do we do that? Well, for any given day, so at any time t, we simply sum the marks that we give to all the articles that are published on that day. And in this way, we construct a factor which by construction is such that when it goes up, that is going to signal an increase in transition risks and vice versa. So then the question is, how does the time series of this factor look like? And this is what we get. In this chart, we have marked 4 different periods. The first period to the left in white shade is a period of time in which the factor hovers around 0. And this were the 6 years characterized by the George W. Bush administration. The fact that it hovers around 0 is in line with the lack of political intention to tackle climate change. Then there is another period of time which we mark from November 2006 and the next 4 years, and in which the factor clearly rises in positive territory, marking an increase in transition risks. And this is a period that captures the last 2 years of George W. Bush administrations, which were the last 2 years in which he lost control of the House of Representatives. And the House was very active in trying to pass bills and fight for climate change legislation. Then the following 2 years were the first 2 years of the Obama administration, in which he had full control of the Congress, and the president has been very active in trying to push through his climate legislation. Then there is another period characterized by a darker shade of gray, a third period, which captures the last 6 years of the Obama administration after he lost control of the House in November 2010. And for all this period, he didn't have control of the parliament. He also lost the Senate in 2014. And so you can see that in this period, the news hover again around zero, signaling the lack of ability of the president to make a substantial breakthrough in the Congress to push his climate legislation. And then finally, President Trump was elected in November 2016, and that's where you see a marked decrease in transition risks, consistent with the declared political intention on which the president followed through. So these are the 4 periods that you can see coming through the figure, and with a factor that is constructed in this way, an increase in the factor, as we said, captures by construction an increase in risks. And this is different from what we had in the textual factor, which we interpreted in the opposite way. So with this assumption, which here we know holds by construction, then we should observe a negative significant alpha on the spread portfolio if the risks are reflected in US prices. And what we see here, we are showing result for the full period, the period from until 2012, and then from 2012 and onward. Now you can see that, again, the significance only really relies on the latest period. Notice I just seen that in the third column, the number 1.39 should have a minus. That's just a typo. So all the results that we get are in fact negative. They are significant with t-stats that are often above the threshold of 3 that is commonly interpreted as a threshold that is reassuring against data mining concerns. So these results hold also for quintile portfolios. So they have robustness both in decile and quintile sortings and across the various models that we have considered. So this is all. This is the paper. So let me just conclude with a brief summary. What we wanted to do was to dissect the textual heterogeneity about climate change. We have decomposed climate change into its various sources, and then we have examined whether these sources are priced in the US stocks. The results gave rise to these 4 factors that capture different types of risks, physical and transitional, arguably at different horizon, but only one of these risks seems to be priced, the one stemming from the US debate that has a shorter horizon, and only from in the recent period after 2012. What are the implications? Well, the implication is that, of course, climate change is a recent phenomenon that has been observed in many studies other than this one. What is important is that there is a set of risks that is not priced, and this is a market failure, so something that justifies policy intervention. I think it makes the point that stock market cannot fully substitute the regulators. And so the next big question that we leave for future research is, why is it that not all risks are priced? And here, of course, there are various possibilities which we could leave for the discussion. It may be, of course, that there is not enough information. So if there is not a sufficient disclosure of these risks, then risks cannot be priced. But it could also be something else. It could be also that investors are myopic, that there is short-termism, and that even if they had all the possible information, they still wouldn't care about the longer-running sources of risks. In which case, policy should do probably something different. And maybe we can leave this for the discussion, and I close it here. It's about the 40 minutes that I promised.
Many thanks, Renato. very clear and interesting presentation. There are a few questions from just understanding your time series. There is one question by Filippo Natoli and by Glenn Koshlow, questioning first the Paris Agreement. So it seems that according to your time series, the Paris Agreement did not have much media coverage in the international factor. Is that true, and what is the reason for that? And similarly, like the Hurricane Katrina seems also, you know, the natural disaster index was 0 in 2005 when the Hurricane Katrina struck. Yep. Maybe you can show back the.
Yep. So. Yeah. So what I can say about those are very good questions. Don't remember exactly about the Hurricane Katrina. I do. Maybe you should look at it again. But what I can tell about the Paris agreements is that it's true they don't. The Paris Agreement don't show there as a spike in the picture, but they show very frequently through the news. I remember going through all those and marking those very carefully. The reason why they don't show up with a spike is because to some extent the discussion on the Paris Agreement is covered a lot by the press before the Paris Agreement, with a lot of statements reported in the press about President Trump saying that he would renege on those agreements. So they seem to have been present, articles about the Paris Agreement constantly in the months that precede the precise timing of the agreements themselves.
One other question by Christophe Mayandings asking, is it really surprising that only one risk factor is priced? For instance, physical risk are often idiosyncratic, or like a local tornado and thunderstorms, so they cannot really be predicted in a sense, I guess.
Yes, but there is also a literature that believes that longer running sources of risks are important and they are priced to some extent. There is a probability that the climate change is worsening, and that will entail more frequent disruptions in the future. And this is a non-diversifiable source of risk that arguably is an important one. Now, whether you believe that it's obvious that it should not be priced or not, it depends on your views on the importance of long-term risk. But there is a school that believes that this matters. I don't know if George also wants to say more on this, or Rustin. Feel free also to.
In the meantime, maybe one question from my side. So if I understood you well, like when you have a lower coverage, so a lower value for your factor, on your news factor, this is equivalent to bad news for you.
Yes.
Right. So,
yes.
So in a sense, it's the inattention of the media, which is a bad news for investors.
Yes, on the textual factor, yes.
Now the question for me is that basically transition and physical risk normally goes in opposite direction. So if you have good news about the transition, saying that the transition with Apple, that's bad news for transition risk, because transition risks are likely to materialize. But on the other side, it's good news for physical risk, because if the transition happens, then climate risk will decrease. So can you really, answer your question about whether whether risks are priced in when both go in opposite direction, and a good news for transition risk might be a bad news for physical risk?
Yeah, absolutely. I mean, this is a very good point. This is also to some extent a limitation of our approach of our factors. Yes, I mean, I still believe that if you think about transition risks, if you have a higher transition risks, that is going to decrease physical risks in the long run, but physical risks tend to materialize only in the long run with a big discount factor, whereas transition risks are more closer in time. So if you balance out the two, the one that should dominate with first order importance is still, I believe, the transition risk. But that said, I mean, I fully agree that the textual factors, they cannot fully disentangle transition and physical risk, which to some extent they are intertwined. And also when we call the factor the natural disasters or global warming, they reflect directly on longer running physical risks. But of course, longer running physical risks also entail some transition risks. In this case, probably they are associated, but there's not perfect disentanglement in this. So this is also so true. Yeah.
May I jump in and add to Renato's reply? I mean, this is a very good question, but please bear in mind the LDA delivers topics which have really low correlation in a way. So Renato didn't have time to show the correlation metrics. If you notice the correlation matrix of the textual factors, the correlations are quite low, and this is a good feature for us because we have chosen the number of topics prudently, and this allows us to get a clear interpretation of each topic. Whereas if we could not disentangle, if the LDA was not disentangling the two types of risks nicely, then you would find quite high correlation. So in general, in this machine learning technique, the low correlations, as we find, is a sign, is a good sign because it enables labeling the factors nicely.
Thank you. I have another question which I'm not sure I understand, but maybe you will. So Leonardo Bortolan is asking, how do you select the 4 topics for your time series? Did you force the algorithm to select these topics?
No, absolutely. No, yes. I don't know if Faccini wants to add also something on this, but we have a total number of 25 topics. I didn't have a chance to show you in this presentation, so that the number of topics is chosen so that we can nicely disentangle among different types of topics, not just this one. We focus on these 4, which are an outcome of the LDA. All we do is to lab. We choose the number of topics for interpretability and the parameters of the priors in these Bayesian algorithms. But other than that, it is all delivered by the textual analysis. We decide to focus on these 4 factors and neglect the others because these are 4 factors that have a clear interpretation that we can interpret as market-wide sources of risks. There are other factors that are about the coverage of the debate of policy, of climate policy in Europe or in France or in Great Britain, in Russia. There are topics about oils, but we leave this simply apart. But it's also part of the heterogeneity that we uncover. Thanks for the question.
And another question about what happened on stock markets in the last year. So we've seen that the stocks of coal and fossil fuel company have tanked in the last years, and then the stock prices for renewable energy company has increased strongly. So does that fit with your empirical result, or how can you explain that regarding what the news or the coverage variable that you use?
So I'm not sure how to answer these questions, only because our sample ends with the end of 2018. So it doesn't cover the previous year. So I didn't have a chance to reflect on this. I would have to extrapolate on a time series that I don't have. So it's an excellent question, but I'm afraid I don't have the data to answer it.
So if you have more questions, I'm just
may I add to the last question? This is a very nice question. There is some recent research which shows that Trump's administration in a way favored polluters, so it increased in a way the stock returns of these companies, and at the same time, surprisingly, it increased stock returns of green companies. So the way that this research explains this seemingly puzzling result for green firms is that it proposes the explanation that people think that the effect from Trump's administration is sort of temporary, and the new administration would come and would overturn this friendly policy towards polluters. So in a way, there is where long-run expectations come in, and this may explain away this result for the returns of green companies.
I would have, again, a clarifying question, probably only for myself, but I would have expected, like if you have a lot of news about physical events like hurricanes, and market are not pricing these factors, that the fact that there is a lot of news would rather be a negative, negative news, in the sense that people start to realize that there is a physical risk, whereas you interpret that the other way around. It's when there is no news or no coverage in the news of physical and transition risks that it's a negative news in a sense. Am I correct?
So Pierre, this is a very good point. I want to clarify. This is an interpretation that we make only for the climate policy factor, because we believe that a lot of the coverage in the US during the Trump administration, especially, there was clearly no intention whatsoever to put any for any transition risk to materialize. So there, the news really reflect the fact that Trump was saying all the time that climate change was a hoax and all of that. So there, the news reassures. But in all the other cases, you are very right. An increase in coverage signals an increase in concern. So the idea being that news rises to the immediate attention when there is a source for concern. So in that case, we would interpret an increase in the factor as bad news for the economy. We would expect a negative alpha on the spread portfolio to emerge. I didn't indulge in this in the presentation just because we find no significance. So I didn't want to spend time interpreting, but I fully agree with your point. Yeah.
I don't know if it's a bad question or not, but I mean, in a sense, if there is no coverage and that is interpreted as a bad news for a market, because markets and so in that sense, if the market interprets no news as a bad news, it would mean that they are integrating climate. So they know that there is a risk, and if there is no news, the politicians are not dealing with this risk, and that's bad news for them. So in a sense, they do integrate this risk because they are concerned of no action by politicians.
Yeah, so it's this is, I mean, I know that when we try to give this interpretation, it is questionable just based on the factor, and one cannot be fully sure how much that holds or not. That is why we in the end we do take also this narrative approach, which should eliminate any of these concerns that one may have, because there we really lead the articles, and we clearly say that it signals an increase or a decrease in transition risks, and that should be the type of exercise that one can do to reassure against this type of doubts, which are absolutely legitimate. There are pros and cons, I think, in going both ways, doing the narrative or doing the textual factor. The advantage of the raw textual factor, despite its may be ambiguous to a certain extent, but that's something in which we really have no control, no judgment. It just comes out of an estimation of that it is totally delivered by the algorithm.
So Carola Moreno is also rebounding probably on this discussion, just asking that given that there is subjectivity on the interpretation of the news, is there one way to check the robustness or on the construction of the factor in term series to account for the content? So do you see any? Given that it's difficult to interpret if a news is really positive or negative, do you see any methodology or any way to make that more?
This is also a very good question. It's a very good question. You know, whatever you do has pros and cons, and you know, we try to do as much as we can. So one thing that one could, I mean, in principle, what we are doing is the most thorough thing that one could do. That is to spend time to individually go through every single article and take this narrative approach. It's a procedure. It's been taken before, especially in macroeconomics. It's quite popular. But as you say, you know, it has a shortcoming, as everything that we do, and it relies on judgment. That's why then we have the raw factor, which does not rely on judgment, but also it's a bit more controversial in the assumption that we make. What is another way that we could do? So something else that we could do in principle is to apply sentiment corrections using dictionaries. The problem with that is that it has been shown that sentiment correction using climate dictionaries or psychological dictionaries are not useful in a context that is different from the context in which they were created. Like if you want to apply a finance dictionary in climate, in the context of climate, that's not going to be very useful, I'm afraid. So I think we tried what we could. If any of you has suggestions, that is good.
I don't have suggestion. I'm not a specialist of that, but that's a good segue to tell you that to tell the audience that there is a Slack page where they could give maybe a solution for you or ideas, or also ask any question that we haven't answered during this seminar. We're slowly coming to an end of this seminar. Thank you a lot, Renato, for your presentation, and also to you, George, for adding comments. There will be no seminar in 2 weeks because I think it's bank holiday in the US, and the next seminar will be on Monday, June the 14th, with Warwick McKibben presenting on climate change and monetary policy, policy design and modeling. So Renato, thank you a lot again, George as well, and see you everyone in 1 month.
Thanks a lot, Pierre, for organizing, for inviting us, and thanks for everyone for listening. Bye-bye. Bye-bye.
Thank you, bye-bye.